We're very pleased to have Steve Mercatante with us today. He is a nationally recognized leader in tax reporting education and consulting on specialized compliance issues. He's the owner of taxinformationreporting.com, a web-based consulting firm employing veteran tax attorneys to provide annual subscribers with accurate answers to their 1099 and 1042-S form-related reporting questions. Steve received his Juris Doctorate from the Michigan State University College of Law, graduating with a Certificate of International Law, and he is an active member of the State Bar of Michigan. With that, I'm going to turn it over to you, Steve.
Thank you, Lauren. Hello, everybody, and welcome to this afternoon's session on all the new changes in the law, as much as we can cover, at least in approximately an hour. So let's go ahead and get started. And what we're going to talk about today, first we're going to do a little overview of where we are in a larger sense. Then we're going to overview some of the bigger changes in talking about what's new. And then at the end, we'll go through some tips on some help with compliance and trying to understand and meet some of these goals in addition to what we've been talking about as we move forward through the presentation. So let's go ahead then and just briefly about the tax gap. I often assume everybody knows about this when I speak in one session or another, but I'm always surprised to find out how few do. And it really does help to understand the big picture of what it is that's motivating essentially the powers that be that are forcing you to do all the work you're doing to meet these information reporting requirements. And essentially what's happening here is we have the IRS, the Internal Revenue Service, and they're primarily responsible for enforcing the U.S. tax laws, guaranteeing that tax levies are collected. The problem here is there's an ongoing gap between the revenue owed to the IRS and what the IRS collects. And so what we're looking at here in terms of that gap is a gap that's fluctuating in the $300+ billion range, $300 to $350 billion. And this is your tax gap. It's caused by a variety of elements. For example, you have some gamesmanship at various levels, hiding of assets, and hiding income in foreign bank accounts, which will tie into some we're going to talk about later. There's another element, though, there that's important, and that's where your organization steps in, at least for the vast majority of you listening today. And that involves the fact that you, employers and other third parties, provide the IRS with independent information about income received and taxes withheld on information returns, W-2, 1099 series, and whatnot. The IRS matches that information filed to the filed tax returns, and then at that point, if necessary, they contact the third-party payers for all kinds of purposes, including identifying persons who didn't file returns, resolving discrepancies between payer and payee records for those that did, and of course to assess tax interest and penalties based on the information gathered or lack thereof. Now this Form 1099 reporting world attracts the lion's share of the IRS's efforts in regards to what we're discussing today because the level of tax compliance associated with payments to independent contractors and non-employees that should be reported on the Forms 1099, it significantly lags the rate of compliance achieved by what we see in the W-2 reporting world. And of course, the IRS is very interested in changing this reality. And because of these recent IRS efforts, the number of cases reviewed by the IRS has climbed, and the discovery of underreporters has climbed by a significant amount. Now, keep in mind, too, don't just assume because there's cuts at the federal level that those cuts automatically influence the IRS. For example, the deal that was sealed to pass last year's budget a few weeks back, or about a month back now, actually maintained IRS funding at its current level. Regardless, the IRS is looking for additional funding to meet their goals. But there's this dichotomy going on right now politically in the sense that there's a lack of will to raise taxes to deal with the deficit. So there are other methods being sought to increase revenue, including what's known in IRS speak as tax expenditures, for example, or closing loopholes, or special carve-outs for different unique special interests. And so there's also this push for concomitant regulatory compliance. At the same time, there's a pushback from the larger community. So that back and forth is what's driving this process and driving what it is you do. Okay, let's go ahead then and move on. Couple of basic, just two basic things I want you to understand moving forward whenever you're kind of lost in this thicket of how do I comply with what the IRS is asking of me. And in particular, there's two simple questions you should be asking yourself. And one is you want to ask yourself, whenever you're confronted with a potential reporting situation, you want to ask about the payment and whether or not the payment's reportable, and then if the payee is reportable as well. And you need to be able to find the answer to both of those to move forward and properly not only comply with the law, but report effectively. So these two questions you see here should always be your baseline and your starting point. You always need to be able to answer those questions, yes, to get to a situation where you can report. So keep that in mind as we're going through and talking about all the changes and updates and differences in the law. Okay, so let's go ahead then, and a couple of more, just some basic things here. Hopefully many of you are familiar with what you see here regarding payments and some of the basic rules of what's taxable and reportable and things such as this. Now, I'm not going to go through all of these in detail individually. It's merely setting the stage for the discussion to follow, but note some of these basics. For example, pay attention to terminology the IRS uses, like taxable and reportable, which are not necessarily the same things, but it means that you can have taxable income to a recipient. You won't necessarily report it, for instance, in regards to a payment made of, for example, let's say $400 for services performed, which is taxable income, but it's below the reporting threshold. Make sure your payments are in the ordinary course of your trade and business. It seems simple enough, but it gets dicey in the accounts payable world when you're trying to track all payment forms and sources, and you need to identify those forms and sources, and what falls within that definition can be, again, it can be a little trickier than it seems. So the bottom line is, what you're trying to do is you need to know the law, and of course that's why let's go ahead and move on then and look at some of the laws that are the most important to what it is you do. Now, listed here, you're going to see three different code sections in the IRC Internal Revenue Code. These are the most important code sections that motivate what it is you're doing. There's obviously been a lot of back and forth, in particular about 6041, which we'll get to in a second. But these are the ones that, above and beyond anything else, you really need to know and be comfortable with. Note 3406, your backup withholding. 6109 is a great code section that can be helpful to you in terms of motivating your payees to provide the appropriate information you need, typically their name and their taxpayer identification number. And so that's the one that actually requires the payee to provide that information. So a good compliance tip would be, when you're confronted with a recalcitrant payee, don't just, get into some sort of argument with them. Just show them what the law is and let them know, look, this is the law that's requiring you to do this. I'm merely trying to follow that law. Beyond the code sections you see here, one other tip I always like to give my clients, whenever you're confused, because when you read through these code sections, what you see here is not what the code section says. It's my translation of the code section into something that you can understand. Typically, the legalese used in the Internal Revenue Code or in larger statutory law is very complicated and not written in the most conducive manner to ease of understanding. So I always recommend, whenever you're trying to figure out what a particular law says, go to the IRS, you go online, go to their forms and publications, and start with the publications. And then look at the instructions for the different forms. Yeah, those aren't the simplest thing in the world either, but it's a much simpler place to start from than trying to interpret the code from the get-go. That said, the code, the law, is what you're going to base your decisions upon, but from that basis of understanding, it's a lot easier for you to then look at that law and see how you apply each section to what it is you're doing. So keep that in mind. Know that the law is what you're relying upon. For example, if you're ever challenged by the IRS, you're going to cite to the law, in response in your answers for the rationale for why you took the steps you took in attempting to meet your compliance goals. But from an educational perspective, you want to start with the publications. Okay, so let's go ahead then. And as I said before, the two biggies here for you are 6041 and 3406. Now, a couple of other things here that I have. Actually, the second to the last bullet point, note that that is the law, Public Law 11132, or 312, I'm sorry, that has extended the current backup withholding rate for U.S. persons, and that's effective until December 31st, 2012. The anticipation was that that was going to change in December. It didn't. It was extended. Be prepared that if it does change, it's going to go to a higher level at some point. Right now, for example, the withholding rate for the non-U.S. person is 30%. So there should be some sort of, I would think, synchronizing between those two, especially as the IRS continues to focus heavily on the non-U.S. person, but as well bringing, and that's the whole 1042S W-8 world, but bringing the 1099 world and the W-9 world up to that same level and actually and beyond in terms of compliance. Note also here that the penalties have increased for Code Section 672122. 24 is another important one in relation to if you're facing a proposed penalty notice and or a penalty and audit. And if we move on, we can see that those have recently increased. Oh, I'm sorry, we'll get to that in a second then. But before we get to that, the increases in the penalties, I want to just briefly touch upon something about the W-9. So let's go ahead to the next slide. Hopefully everyone's had a chance to review the new W-9 that was issued in January. A couple of things about it, and obviously we all know the W-9's been changing regularly. The IRS has changed it over the years, ostensibly to make it easier to use. My initial reaction to it was a bit of disappointment, in all honesty. If you were to look at the W-9, and if you have one in front of you, that's great. But when you look on the boxes at the top of the first page, and I'm sure you guys have seen these so often that you can recite what it looks like in memory, falling asleep at night, God forbid. But you're going to see there the IRS has attempted to deal with the issue of the single member / disregarded entity, LLC. And what they've done is, in their attempt to simplify the form, I believe they may have potentially made or provided for some confusion. And the reason is, when you look at the form, and if you don't have it in front of you now, that's fine, but just think about this. When you look at those boxes, look at them from the perspective of your payee, okay, when they're trying to fill this form out. And the problem I have is I don't feel like the boxes are explicit enough in terms of what they're asking and what should go in what box. So if I'm a sole proprietor and I'm looking at this form and I know I'm a single member LLC, I'm confused about what box I should check. Should I check the sole proprietor or should I check the LLC box? If I check the LLC box, how do I know what my tax classification is? I don't see anything for individual sole proprietor. All I see is C corporation, S corp, or P partnership. I know I'm not a partnership. I know I'm not a multi-member LLC, so what do I check? Now, the answer is on page 2 of the form, buried in the specific instructions for name. And it goes through there and it describes what to enter if you're a disregarded entity or what to enter if you're a limited liability company, an LLC. The problem here is, again, and it's the problem we've run into again and again and again, yes, you can make the instructions more explicit on pages 2, 3, and 4 of the W-9, but the reality is you want it, that very first page, that face page, to be as clear as possible. And so I'm highlighting this for you because even though the idea of the change in the Form W-9 was to make it clearer, in part, I mean, that's essentially what they're doing. They're not trying to hide the ball here. I feel like an unintended consequence is that your basic individual payee that looks at that is still going to have questions and not know which box to check, and thus they may still mistakenly check the wrong box. Thus, you need to be aware of this problem. you need to understand it yourself, because you're probably going to be in a situation where you're going to have to continue to explain to your payee when you get a W-9 back, or question the payee and do what's known as your due diligence, which we'll talk about a little bit more later on, in terms of getting the requisite information from the payee, getting that name right, getting that PIN right, and making sure they match up properly. So unfortunately, that's the problem I have with the new W-9, and it's something I want you to pay attention to. As well, there's new tax classifications on there, but they're pretty self-explanatory if you go through the instructions, and so I'm not going to spend any time on that here, but I did want you to focus on and look at what I see as a potential red flag on the new Form W-9 in terms of creating you difficulties this compliance season, and then when it comes to reporting at year-end. Okay? All right, let's put that W-9 away and move on now. And so earlier I had mentioned the increased penalties. Hopefully everyone is aware of this, especially as we move through B-Notice season. Not that a B-Notice automatically leads to a penalty, okay, but you can end up then down the road having a proposed penalty or an audit based on discrepancies found through the B-Notice process. And so what we've seen is there was an increase, the new Small Business Jobs Act. When I say new, it was actually passed last year in 2010, but obviously that's still relatively new. And what it's done is the penalties have increased significantly. And so I'm not going to read through all the details of each particular, dollar amount difference, but in essence they've doubled. And by the way, it's summarized here. The presumption is that the maximum penalty is reached by August. Theoretically, you don't hit that maximum if you catch the mistake within the first 30 days and whatnot. There's different tripwires. But in reality, most miss the mistake until they're confronted with the potential, either the mistake through the B-Notice, and not that the B-Notices are always right as we know, or some other mechanism which has triggered you to then look at that, and by then it's too late, so you're at the maximum potential penalty for that particular issue related to that particular return. Note intentional disregard. Just as a reminder, I like to always stress with my clients, be very careful when you see IRS terminology and make sure you interpret the terminology the way they interpret it. Don't interpret it the way you do. Definitions are critical. You may look at intentional disregard and think it means something like outright fraud, for example. The reality is it doesn't. In the IRS's eyes, you can have an intentional disregard penalty simply by not following the law, because the expectation is you know the law and you are following the law. And this can get tricky because there can be various areas of the law you're completely up to speed on. For example, maybe your data collection procedures. Maybe you've already got a system in place to deal with the new W-9 and are comfortable with the changes and are okay moving ahead. But then let's say at another level, oops, you forget to do something else properly. If, for example, in terms of how you corrected a type 1 versus a type 2 correction error on a return or something like that. I can go on and on, obviously, with different examples. Point being, from their perspective, how come you don't know that point of the law? And then that can lead to this inference that, well, if they're not following this aspect of the law, are they intentionally disregarding the law? And then are they putting, and it goes from there. And the problem there, as you can see, is there's no upper limit on those penalties. And that's the big one you obviously don't want to trigger. Okay, so be careful this compliance season then, because you are on the hook for greater penalties than you have in the past. And obviously they're up significantly, essentially doubled, as you see here, either the early within 30 or then the late when you fail to catch it until to the end. Okay, all right, let's go ahead then and move on. And I mentioned earlier when we first got started here about some of the increased focus on reporting with the non-U.S. person. Today's webinar is not about non-U.S. person reporting. However, one of the big new changes in the law was these changes related to this acronym you see here, FATCA, the Foreign Account Tax Compliance Act. And that doesn't come into effect. We still have some time, as you can see here, January 1st, 2013. And for most of you, this won't necessarily apply to you. But and for some of you it does, and for those of you who are listening who meet the definitions here, are financial institutions or non-U.S. financial institutions with the greater identification, disclosure, and reporting of the U.S. accounts rules that this is focused upon that are listening in, I've included information here for you to look up and follow up on, particularly the notices you see quoted at the bottom of the last bullet point on this page. For the rest of you, again, it's here to show you the IRS is deadly serious about the non-U.S. person reporting issue. It's one of the hottest areas of focus for the IRS, has been for several years, and I want you to make sure you keep it on your radar and are particularly careful when you're, for example, using the W-9 and trying to transition between the W-9 and the W-8 report, or collecting data collection world, for then reporting on the 1042-S, because it is such an important area for you to focus upon, because the IRS has made it a priority. And this is emblematic of that priority because of the level of, as you can see here, a pretty significant crackdown on what's happening abroad with U.S. accounts, that U.S. persons who have accounts abroad, for example. And you may have heard of this in the popular, or in the, not the popular, in the mass media as well, relating to the recent settlement with the Swiss and things like that. So this is definitely something that should be on your radar. Okay, I think the next slide we have a little bit more about FATCA, and the most recent notice you see here, which was just recently issued a few weeks ago. And again, if you're a foreign financial institution listening in, that is something you very much want to look at. In general, you know, you can touch base on this, but again, there's other things I'm talking about for everybody else today that they really want to focus upon. Okay, so let's go ahead then and put that behind us. And obviously the biggie, what everyone's been waiting for. There's been a lot of back and forth, a lot of political football. There's been talk of repeal for a long time. It finally happened. House Resolution 4 just a few weeks ago, April 14th. Now, I don't know how many of you have actually gone and looked up the resolution and looked at what was signed into law, but it's brief, okay? It's just a flat-out repeal. Now, that's interesting from my perspective, and it should be from yours, because now what we need to do is we want to see how is the IRS going to follow up on this. As you've seen before, you've seen a few notices through here sprinkled out, but you've, I'm sure, been confronted with Treasury determinations, revenue procedures, and notices, and these are all the tools that the IRS uses to communicate with you and let you know there's a change forthcoming, because there's always one that's issued. Then it gives you, and that one gives you a chance to comment. Comments are collected, and then there's a final regulation that's issued incorporating either some of those comments or not, depending on what direction the IRS wants to go with them. So our hope is the IRS will issue some further guidance, because the questions that arise from that is this a flat-out repeal? Does this take us back to where we were on March 22nd, 2010, the day before the Patient Protection and Affordable Care Act was signed into law, and Section 9006, as part of that law, was then made law? Does it do that in its entirety, or are there bits and pieces of it that are still something that's going to be part of the process? My presumption in reviewing it is it's a complete repeal, and it's a complete step back to where we were back then. But I'd still like to see some follow-up and further guidance from the IRS on this issue. So if we move on to the next slide then, what should you do? You know, there's a few things here. One's talking about, you know, the tracking mechanisms that cover services. You know, if you've already made some changes, okay, what does this mean? You know, some of the things you need to think about. So don't just think it's kind of a free-for-all now. Go back to the mindset you were in the year before, okay? Go back to that, okay, now I'm back to making the distinction between goods and services. That becomes important again, because obviously with the new law, it was, well, we're reporting goods and services, so that debate was no longer important. So if you started preparing for the new law and started leaving that mindset behind, now is the time to walk back, and now is the time to make sure you and your staff are on the same page regarding doing the kind of analysis you need to do when you're confronted with an issue and you're wondering whether the use of a good potentially rises to the level of a service. And you know, there's all kinds of examples you can use that look at that, but think of a highly specialized good, for example, that's created to your specific recommendations or requirements that's not an off-the-shelf part. Is it potentially something that rises to this level of a service? That's that analysis you need to go back to. Think about when you have a good but you need a service to use that good, and that whole issue that hopefully is still fresh in your mind. For example, you go and get a flu shot for everybody in the company. That flu shot, that good, is non-reportable under the law as it was before and now as it was walked back 2 weeks ago. But if you need a medical professional such as a nurse to administer that good, then that purchase rises to the level of a reportable service because you can't use the good without the service. So that whole can of worms is reopened, and you need to be on top of that. You see the term here, due diligence, intentional disregard. I mentioned intentional disregard earlier. You heard me mention the word due diligence. Again, be careful here. Make sure you follow the steps you need to follow to walk through the analysis. Essentially, everything you're doing should be grounded on an analytical process. I started the day with 2 simple questions you should ask yourself. So you should have, in essence, some sort of flow to your compliance efforts that walks through a consistent analytical process so that when you're confronted with different issues involving, for example, goods versus services, you're not reacting ad hoc to it. You're not flying by the seat of your pants. You have some sort of policy and procedure in place that's systematic and consistent within the idea, the larger idea. Never forget that regulatory law is very gray. It's not cut and dried. It's not black and white. And so the analysis you use, the information you collect, the data you collect, and your ability to show that you're doing so under the, and this is all in writing, okay, it better be in writing, and then in relation to show that you're following the laws and you know what the laws are, is the key to your success in terms of compliance, avoiding or dealing with proposed penalty notices, B notices, audits, and every other nasty thing that can happen out of this process. Okay, so let's go ahead then. And some other issues created then, I think I had already mentioned here, what does repeal mean? It's nice to see the law was repealed. It would be even better to see some additional guidance from the IRS. And another reminder about the W-9 and data collection, because of course this repeal goes hand in hand with the larger data collection issue. And hopefully, if there's been a repeal, there were always, as we talked about the goods versus services distinction, there were long-standing problems with the old reporting regime. Now would be a great time for the IRS to issue some further guidance about some of those issues. So that's something that hopefully the community will be able to express. You know, for example, there's ERPAC and there's things like that. But if there is further notice issued, those notices, again, they give you a chance to provide commentary that the IRS listens to. So you're going to want to look for those notices, and you're going to want to see what the IRS is saying and look for that comment period where you can provide feedback, letting them know this is a concern, we need this to be addressed. Believe it or not, they do address those concerns. And there's a couple of examples later on today I'll show you, but they both relate actually to the new P-card rules. Which is not something we'll cover in tremendous detail, but we will cover. So let's go ahead and move on. And when we're talking about those P-card rules, really, obviously, this is for the, you know, as the IRS calls them, the merchant acquiring entities, and they have all kinds of other fancy, wonderful, you know, the payment settlement entity, the merchant acquiring bank, I'm sorry, and all kinds of other wonderful definitions for really a small group of entities out there that don't necessarily apply to many of you on the face of the law, okay? But still, there's a few things you need to be careful about. But again, you see here the Treasury Determination 9496, and that's what I was kind of, if you weren't getting what I was saying about the whole repeal of Section 9006 of the PPAC A via HR4, I know I'm throwing a lot of numbers at you, but I wrote them all down in the slides, okay? So you use the slides as some notes to go back on and look at. I packed these slides with a lot of information. So when I'm just throwing these numbers out, you know where to go back and look. But when I was talking about that earlier, I was talking about that difference between a law and then the actual code section, and then the further guidance. This Treasury Determination 9496 was the further guidance that told you, let you know, how Section 6050W needs to be implemented. And for example, 6050W has been around for almost 3 years. The former President Bush signed it into law in July of 2008. And then there were proposed regulations issued thereafter, and I believe that was in December of 2009. And then the final regulations, TD 9496, weren't issued until August of 2010. And when the proposed the first notice, the proposed regulations came out in 2009, there was a comment period of 3 months where you could submit your comments and ask for clarification on the law. And that's what happened here. And so 9496 came into law in August, and it responded to some of that commentary. So if we move on, one of the things that looked at was that one of the problems that right away became apparent with 6050W was an overlap with 6041. And 6041 is your basic, that's your reporting requirement for services, okay? And so the issue was, well, which law do I apply? Do I apply 6041 or do I apply 6050W? Because 6050W is putting the reporting burden on essentially what we know as the banks, but these large financial institutions that are the credit card issuers. And so what the IRS did was they responded to that concern from the information reporting community and said, well, here's what happened, 6050W controls. Okay, and you see that in the bullet points with the red bullet points, the hey, look at me bullet points. Those, that's where we describe, where I'm describing there to you, that in terms of that dilemma, for most of you, the burden is now elsewhere. Okay, so, and not to belabor that point, so let's move on. Now, there was additional overlap, and that overlap was the 3402T, and that's for the governmental entities. Now, obviously there's a lot of you listening in today, but the overwhelming majority of you are not governmental entities. So what I've done is I've really packed this slide and the following slide with all kinds of juicy details about addressing the overlap. But the bottom line of all this, to get through it a little bit quickly and get to some stuff that relates to more of what everybody else is listening in for, is that the IRS has essentially punted the issue down the road a bit. And so right here on this slide, you see kind of an overview of the issue confronting you if you're listening in as a governmental entity and some of the problems you face. And then if we move on to the next slide, now, and here's at the top of the slide, you see then some more about the problems. At the bottom of the slides where we get into just recently in December of this past year, so about 5 months ago, you have Notice 2010-91, which addressed this concern about the overlap with 6050W and 3402T. And so what you're looking at here is this essentially 18-month delay from the date further guidance is finalized. So there's a safe harbor, essentially, is the term used, where the IRS has provided some additional time where the 3% withholding will not apply to payments by payment card until at least this time period is expired. And that's how they chose to address the issue at this point, undoubtedly because there's a lot of pushback on all sides related to 6050W and how it relates to the previous reporting requirements instituted by 3402T. Now, for everybody listening, with 6050W, there's the new Form 1099K, there's the Treasury Determination 9496. A lot of you are sitting there looking at it and saying, hey, I'm off the hook on some things. You still need to be careful. You need to be very careful. And I highly, highly, highly recommend you review Treasury Determination 9496 so that you don't actually accidentally turn your organization into an organization that could end up meeting the payment card reporting requirements. And that's something that's more easily done than you would suspect. And so you want to be careful of that, okay? And again, there's a few examples in the Treasury determination that I recommend you look at. It's at the back of it. It's a long document. It's about a 60-page document, but it's written in fairly plain English. It's easier to study than a statute. You just find it on irs.gov. It's very easy to find, and check it out and make sure that you're not potentially doing something that allows your entity to rise to the level of being the type of third-party payment provider that may fall under the guidance of 6050W. It's not likely that would happen, but it could, and so that's why I want you to especially take a look at that. Okay? All right, so let's move on. Okay, now this change in particular has been around since June, obviously, of 2010, but it's something I wanted to go over today. It's still a bit of a new change because this is only the second B notice season since there has been a change in the B notice processing procedures. And because that's something that's current right now, it's fresh with the spring B notice season, I just wanted to make sure everyone was on the same page about this, quote, second B notice situation and the changes. These are, by the way, they were long-awaited changes in the sense that the IRS first discontinued the old Social Security Administration Form 7028 late in 2009, and then it wasn't until June of 2010 that they issued some follow-up guidance on a second B notice situation. For those of you that are listening in that are, what's the second B notice, just a brief review. And this goes back to Internal Revenue Code section 3406 that you saw earlier on one of those early slides that I was talking about, and that's the one that requires you to back up withhold. So that's what this all relates to. But under 3406, a payer has to send certain notices, and the B notice, after being notified by the IRS that the payee has provided an incorrect name and taxpayer identification number, TIN, with respect to an account. Now, if you as the payor get the IRS B notice, which by the way isn't B notice, and I don't think I have it on here, it's actually CP 2100 or CP 2100A. B notice is kind of a term of art related to the particular code section that applies, because of course the code section is not actually 3406, it's 3406 subparagraph A, subparagraph 1, subparagraph B. Yeah, fun, but there it is. So if you get one of those things, the basic rule is you have 30 days to verify your payee's name and TIN, or you have to begin backup withholding. Now, within that process, there's a number of steps you need to follow. And first, ultimately, you should always research your own records. Make sure the error generating the B notice wasn't because of your mistake. And then after making sure you didn't make a mistake, that's when you contact your payee. You don't respond to the IRS. You don't do that. You contact the payee to obtain their name and taxpayer identification number. And you're going to either do this under what's known as a first or a second B notice circumstance. Now, if you're in a first B notice situation, the payee has to respond to you within 30, and by the way, that's business days, okay? You don't want to mess up the timing. It's business days. A lot of people confuse the timing for this versus responding to a proposed penalty notice, but that's in calendar days, and then the number of days are different. It's 45 versus 30. So here we're looking at 30 business days, and what you're looking for in that first-time situation is a new W-9 signed under penalty of perjury. Okay, not an old one, but one dated after the date on the B notice. Now, the second B notice situation, that's a situation where you've had two B notices to the same payee in different calendar years or tax years during a 3-year period, okay? And so in that situation, the payee has to go to the IRS, well, the IRS or the Social Security Administration, the governmental entity that issued their TIN, and they have to get from them documentation showing what their correct TIN is, okay? Now, in the past, the form they would get from the Social Security Administration was 7028, but of course, in 2009, they discontinued it. So, Announcement 210 in June, or 21041 in June of 2010 came through and instructs then what you should do, and that's what you see here on the slide then, in this situation, and that's contacting the Social Security Administration. when you're contacting the not you, when your payee is contacting the IRS, they're getting a different form from the IRS, okay? So this is only in those situations where the TIN was issued by the Social Security Administration, and then the payee in that second B notice situation has to contact them, has to get verification of their information from them, and then that all has to be responded back to you within the deadline for you to avoid backup withholding. Otherwise, you start your backup withholding. So that's what this is all talking about. I hope that by now everybody has updated their policies and procedures to reflect these changes because, you know, obviously it can create a big old mess if you're still trying to do things the old way and you're not getting the responses you thought you would. So make sure, not just you, but everybody on your team is up to speed on this. You know, just ask some simple questions, maybe have a meeting. But this is not something you want to trip you up this compliance season because of the fact of all the other changes going on in the law. And it's something that I mention it because a lot of us obviously have to process quite a few B notices, so it's a common issue, but it also can then become a common error if you let the simplicity of it slip below your radar, okay? So be careful with this change. Everyone's focused on the goods versus services and the corporation payments and, you know, the big 9006 issues, but this one is really on a practical level as important as anything else, and obviously it ties in as well to the increased penalties that are applicable if in fact the B notice is indicative of something else and it leads to then a penalty or a potential penalty notice or an audit down the road. And again, not that they tie together, okay? Don't automatically assume you're going to get a proposed penalty notice for a particular payee because you got a B notice, and don't assume because you didn't get a B notice you won't get a proposed penalty notice. Okay, those things do not automatically work hand in hand. However, there have been no changes in how you process a proposed penalty notice, so if you're up to speed with that one, that's great. If you're not, now is the time, the spring and the summer, to look at that and get ready because those always come out late in the summer. Okay, so let's go ahead and move on. All right, and so for most of the rest of the day, we're going to talk about state reporting, and in part because there's been a colossal number of changes in state reporting. The problem is I could literally spend the entire day talking about these changes, and obviously within the framework we're working in, that time is not here. So what I want to do is give you some of the basics of the issue, and then with a special focus on unclaimed property, and I'll explain why that's so important. But knowing when state reporting is required and under the circumstances it's required is a pretty tough job. And in particular, that's because each state has its own laws on reporting, okay? So I can't speak to state reporting like I can by dealing with this monolithic IRS that has the same rules at the federal level that apply to everybody around the country. Each state's different. Some states, of course, as many of you hopefully know, don't even have information reporting. Now, unfortunately, many of you aren't aware that there are these state reporting requirements, which at this point is beyond me because it's really something that you need to be focusing on. Now, what's not beyond me is how to determine your reporting requirements. That can be pretty tricky. And so again, I want to give you a basic analytical tool for dealing with this, just like I did with those two basic questions at the start of the day. Okay? Now, you're going to have not just states, by the way, but cities or municipalities potentially that you're going to have reporting requirements to. But what happens is here, in general, just so you know too, most states essentially seek the equivalent to federal Form 1099 reporting as it relates to their state, though. But that is not a given, and so there's a wide variance in reporting requirements. So, for example, some states want copies of all Forms 1099 filed with the IRS. Other states merely require forms when state tax is withheld. It's entirely possible you deal with a state that only wants certain forms or a state that has its own reporting thresholds. Some states have their own forms that replace Forms 1099 for state reporting, while other states don't require it at all. So where to start from, your analytical process is the key, okay? And my advice, our advice, my company's advice is simple. Start by determining in which states you conduct business. What states are you doing business and generating revenue? Once you figure that out, you're going to know those are the states that you're going to have reporting issues, okay? And what you're looking at, it's a legal term of art, but those states that you have nexus with. The states you're doing business and generating revenue in are states you have a nexus with in terms of your reporting requirements for that state, okay, that connection with that state. And it's not a simple process determining nexus, okay? It's highly fact and circumstance dependent. To simplify the process, you should probably begin with your business locations, okay? You're going to have nexus with states where your offices are located because you're conducting business in those states. Always ask yourself, though, do I have business activities generating revenue in a particular state? Do I have business activities generating revenue in a particular state? If so, then you're probably going to have a filing requirement. And if you're doing business in many locations, then you're going to have many different types of filing requirements. And so, and the other thing you want to look at beyond your physical locations, another one would be your payee locations and the states where they have performed services. So the state where your payee resides is often a state where services are performed. And if that's the case, you may have to follow that state's rules. Remember, the nexus is dependent upon specific state rules, okay? So if the payee resides in one state but performs services in another, you're going to need to examine requirements for both states to determine where you have the responsibilities. Now, again, this is a big job. Another thing you could look at, for example, in determining nexus is whether you withhold state income tax from payments to a non-employee. If so, then you're going to have tax information reporting requirements for that state. In addition, those requirements won't be only on the 1099, but they might be on the state form specific for remitting the tax withheld. Okay? So regardless of the amount of the tax withheld on a payment, you must remit that amount to the state. And then you have how do you send or deposit the state taxes withheld. You know, so a lot of times you have to register with the state as a withholding agent. Each state has its own forms and process for registering. Now, there's a larger move amongst the states, which is reflective of what the IRS has been doing in regards to electronic filing. And many states now have an online registration process, which is making things a little bit simpler. You know, and if your organization is already making certain kinds of payments to a state, for example, sales or use taxes or employment tax payments, then most likely you already have a state identification, okay? And upon registration, you've received the state tax identification number, and then you're going to use that number when you submit your withholding forms. Now, another thing you should look for when reporting, because again, it gets more complicated than just looking at that individual state, does the state have a reciprocal agreement with other states? And most often, this is what I mean is an agreement between states that border on one another. But they can extend beyond that definition. So I'm based out of the Detroit area in Michigan, and Michigan has a reciprocal or reporting agreement with Ohio, Wisconsin, and with Minnesota and Kentucky. Out of all those states, really, when it comes down to it, we're looking at, you know, I mean, we don't have a border with Kentucky, okay? So we're looking at other Midwest states, but you think, well, Kentucky, how does Kentucky and Michigan relate? I can see how, you know, Ohio and Wisconsin and Minnesota do. So it's not always that simple. You need to go to that state, go to the law. You know, if a Michigan company hires a worker from Ohio, the Michigan company may not have to withhold Michigan taxes, but rather withhold Ohio taxes because of these reciprocal agreements. So this will create Ohio reporting requirements for the 1099s and the withholding. So it gets pretty complicated, okay? You know, I don't want to go overboard on this, but another issue to look at is new hire reporting of independent contractors. That's been a hot area in state law lately. There's a variety of states that require this new hire reporting within a specific period after signing a contract or paying the contractor. And some of these states include Alabama, California, Kentucky, no, not Kentucky, I'm sorry, Connecticut, Iowa, Massachusetts, I think New Jersey does now, Ohio, and so on. There's a variety of states actually that require this, okay? And many other states have voluntary new hire reporting. And actually Kentucky has been on the voluntary, that's what it was, not the mandatory. You can probably take a wild guess the voluntary will become mandatory at some point. And so even states that you typically don't associate with stringent reporting requirements, states like Wyoming, for example, are states that meet this standard. And the thresholds and other requirements, it all differs from state to state again. So it's a difficult task. It's somewhat simplified by the electronic process, and that helps. Publication 1220 is a great tool to look toward when you're dealing with electronic filing and state reporting. But as you can see here on the slide that we have right here, you know, I identified for my clients this year when they were, you know, most of you are done filing your taxes or just about to be done. If you hopefully were wise enough to go and get your extensions, 30 major reporting changes amongst the different states just for this year alone. And there have been big changes over the last few years. I anticipate more to follow. The states are strapped for money. I mean, absolutely, they're facing, you know, a financial cliff, and so they are going all out to find different sources of revenue. You know, and to that end, for my clients, we provide subscribers. It's an updated form and threshold chart that covers these big changes. Now, it's a pain in the neck to put together. It doesn't mean you can't put something together on your own as well or figure out how to do this on your own. But just know that it's a pretty big project. Leave yourself the time to get it done. But you definitely, even if you're not seeking outside help from a contractor such as myself, make sure that you have someone in your AP team who is looking at state reporting issues. And I went through a whole laundry list of larger issues, but in particular, one of the state reporting issues you need to look at is unclaimed property, okay? And what this means, just real briefly, it's also, by the way, the legal term is known as escheatment or escheated property. It's also known as abandoned property. And what it is, it's property that's either tangible or intangible. So when you think property, don't just think something like, you know, real estate, okay? Think of money, all right? So it's something that's tangible or intangible that the true owner has not claimed or exercised any ownership rights over during a certain period of time. And that period of time is defined by the different state laws. So what it is, it's really all about state property laws. And this is in part why it often flies under the radar of your standard accounts payable department. Now, if you think of what's often meant by unclaimed property, then you better understand why this is an issue you need to address. For example, so some examples of what I mean by unclaimed property. You know, refund checks, traveler's checks, money orders, royalties, uncashed payroll checks, checks issued to vendors but not yet cashed, unclaimed gift certificates, all kinds of other categories of payment held or issued in the ordinary course of your trade or business that end up constituting a debt or an obligation of your organization to a creditor / owner, and which remains unclaimed for longer than the state's statutory dormancy period, which is different for every state, okay? Unlike our discussion of nexus, the tricky thing about it is that you may have legal responsibilities over unclaimed property you may not even know about, and these are truly issues involving your payees that are not just your current payees, but your past ones as well. And there's responsibilities you have as a holder of unclaimed property in terms of reporting. And these, you know, I'm not going to go through all the details of these responsibilities, but they include, you've heard me mention before, you performing your due diligence, meaning that until the property is transferred, you're ensuring that the proper internal controls are in place for claims processing and to avoid fraud. You're essentially safeguarding the property while it's in your custody. You're maintaining documentation to show you're safeguarding the property, and you're filing the right reports. And when it comes time to remit the property, you're keeping these records related to the unclaimed property. The fines and the penalties are unique to each state, but they can be extensive, so be careful here, okay? And then there's a whole host of rules about whether and when property is abandoned or not that you want to be careful with. But just pay attention to the individual state laws. They're all different. In particular, the laws on handling the dormancy period or the time period since the last date an owner generated any action on their property. And it's crucial to determining your reporting responsibilities. So there's been a lot of changes in state law, okay, and there's going to be a lot more. Make sure you're on top of it. Make sure you're addressing it. The states are, again, they're really, I mean, because in the private sector, most large companies are flush with cash right now, okay? Profits have been through the ceiling. There was a lot of cost cutting that was done during the recession, and since then, the corporate profits in particular are just skyrocketing. It's not the same situation at the state level. There are cuts going on across state and local governments. People, though, are demanding similar levels of service but with less cost, so they're looking for revenue. These are the ways, some of the ways they're looking for revenue, and they're looking a lot harder than they were years past. So it behooves you to pay attention to these changes as well as the federal changes I'm sure you tuned in to listen about today. So what can you do moving forward? Let's go ahead and move on and look at some of the things you can do in terms of your compliance. Again, go beyond the IRS, and so this is just what I have here is a short list of the different things you can look at. But again, the nexus, which states have jurisdiction over your business. I briefly mentioned earlier the cities or municipalities. In the state of Michigan, there's 20 cities that have reporting requirements in addition to the states. Something I mentioned nothing about today, but which is vitally important, is the worker classification related issues. You think your worker is an independent contractor. The IRS says no, they're not. They are an employee. And because you messed that up, you're going to have to go back and not only pay penalties and fines, but also all the payments that were not made to that worker as an independent contractor that as an employee they would have been owed, and the withholding for the requisite taxes you do for a worker or for an employee that you don't do for an independent contractor. Moving on. How you protect yourself, there's a variety of ways. You've heard me mention written policies and procedures. Vitally important, especially for showing how you handle the transitional periods with the new laws, how you deal with what the law was, what it is during a transitional period and what it's been changed to, or this whole back and forth. One of the #1 reasons to have a policies and procedures manual is not just, it's to have that systemic, consistent handling of difficult issues that I talked about earlier, but it's also great for closing out audits quickly, especially if it's something that you actually use. It's essentially a living document in that sense that you can show an auditor. It's a great tool. And then let's go ahead and move on. And so remember the analytical tools I talked about today, okay? So that way when you're confronted with new laws or you're trying to figure out some of the older laws that you're just now getting around to, or you're trying to streamline some things you're doing with the non-U.S. person, whatever the issue is, the non-qualified deferred compensation you see here, which was not a topic today, but which is a big area of IRS concern, which is why I put it on here, you have this consistent process in place. And so I'm not going to read through these, but as you can see, there's a number of levels and things that you should be looking at, and a number of different types of processes you should be setting up for the different approaches you have to take to meeting your federal, state, and local reporting requirements. Okay? And I believe that was it. Yes. So thank you, and I'll turn it over to Lauren, I believe, and Neil. Thank you.
Great. Thank you so much, Steve. It's really great information, and we do appreciate your expert view on these issues. Briefly, I'd like to turn this over to Neil Lefevre, who is a product manager for Convey Compliance. Neil, can you just take us through a brief explanation on how Convey can help with some of these upcoming regulatory and compliance changes?
Sure can. Thanks, Lauren. So just real quick, Convey is the industry leader in providing flexible, on-demand tax information and withholding management solutions. We leverage our unique application of technology and 25 years of proven experience to serve thousands of clients with streamlined tax information reporting solutions. Through our service and software, we help our clients' businesses run better, reduce their risks, and improve their bottom line. So as an organization, Convey is solely dedicated to tax information reporting, and we offer a variety of products and services to both educate and support the information reporting community. All of our products and solutions will guarantee your compliance with any of the 1099 series forms, as well as 5498s, the 39 series of forms, 1042S, as well as other form types like Puerto Rican forms and Canadian forms as well. So what can we do to help you? Well, Steve mentioned kind of a lot of scary things throughout some of his presentation. For example, increased audits, the IRS taking a closer look at the returns it's getting, increasing penalties for late and incorrect filings, and in a lot of cases doubling what those penalties look like. So Convey is focused on compliance and reducing that risk to your organization. And we have a dedicated compliance team which monitors lots of different websites and publications to stay ahead of the ever-changing tax laws. And we also work with individuals like Steve and his organization to make sure our products meet the compliance needs that are out there and make sure that you aren't at risk of audit and reduce the penalties and penalty risk that you may have. And Steve mentioned a variety of things, a new W-9 this year. There's also a new 1099B form, 1099R, so there's lots of changes, as well as things like state reporting. We find that a lot of clients have a lot of questions and concerns about if they're in compliance at the state level, and Steve did spend some time talking through that. So know that organizations like Convey and Steve's organization can help you through those questions and make sure that you are in compliance. And then beyond just making sure you're compliant, we also put a lot of focus on centralizing and automating your tax reporting process. So we centralize all the payments that are occurring throughout your organization, get them all in a central location so that you can produce compliant forms, apply things like federal limits or federal thresholds that Steve mentioned to make sure that you're only sending out forms that are needed, so saving you print and mail costs, as well as offering things like statement delivery or electronic delivery so that you can reduce print and mail altogether. So those are just a couple things. We also focus in on TIN compliance in the B-Notice process, so making sure that organizations have correct TIN and name information and helping you through that W-9 process. And then finally, withholding management, making sure that payments are getting made to the appropriate locations and the money is being deposited with the appropriate agencies. So beyond just the products and services that we offer, we also focus a lot on thought leadership and education. So we put on webinars like this with industry experts. We also have a 1099 news blog, which you should definitely check out to stay on top of all these different changes. We put out a variety of newsletters, and Lauren mentioned at the beginning, actually maybe you didn't quite hear it, but we do have a C2 Summit, which is our annual conference, and we have sessions just like this one over 2.5 days where we have experts like Steve come in, provide compliance information, as well as provide user training and other topics to help make sure you're educated and also make sure that you're getting the value out of our products and services. So with that, I'll turn it back over to Lauren.
Great. I just want to say a big thank you to both Steve and Neil today. And before we conclude today's webinar, I would like to let you know that this presentation has been recorded and will be available to all of the attendees on the convey.com website within the next week and a half or so. And you'll also be receiving an email from us. We have gotten a lot of great questions today, and to honor your time, we, Convey, will work together with Steve to provide a frequently asked questions document, again, in an email to you later this week or early next. If you do have any more questions, or if you want some more information on Convey solutions, please visit us at convey.com or give us a call at 1-888-303-0700. 1099. And with that, we are concluded for today. Enjoy the rest of your afternoon.